Hello, guys. Welcome back to another episode of Quadrant Lunch Talk. And of course, once again, we should be still within Chinese New Year, right? I think so. So once again, 恭喜发财 to every one of you guys. Hope that you guys have an awesome Chinese New Year. And today, basically, I'm going to touch into the low interest rate environment. So basically, low interest rate have quite a few meanings when it comes to the property investment world. Yeah. And before I jump into the whole topic of what does low interest rate really means to you as an investor and as a home buyer, if you guys are online and able to hear me, just type in the chat and I would love to just welcome you over here. Okay. So let's start off with this is that, of course, there is always a pro and con to any stimulus or anything that happen to the market. So we are here to really explore down what are the disadvantages and what's the advantages when it comes to the low interest rate environment. So number one thing is that we see a news like this, which is, of course, global news, which is mentioning that the Federal keeps interest rate near zero amidst pandemic. Of course, once again, we are in the time of semi-crisis in a sense, is that the pandemic is here and it's unlikely here to, and it's more likely here to stay for the next 1 to 2 years until every single one of us get vaccinated throughout the world, not just in Singapore alone, right? Everything else that happens outside Singapore also indirectly impacts the economy of Singapore. And therefore, in this scenario, when we are seeing news like this, global news like this, where interest rates are basically to be kept near zero, we can then also expect that Singapore interest rate will also be kept low. Put it that way, won't be zero, but technically low. So the key thing is why I think one of the most biggest confusions is, hey, why is it that when interest rate is near zero or zero, sometimes even hear negative interest rate, right? But then how come when we take a loan from the bank that is actually still a so-called percentage that we still need to pay the banks, because banks typically still take a spread. So typically there is the federal interest rate or interest rate on the board, and then of course there is the bank so-called margin itself. So usually we add on the bank margins, and that is where of course then we pay the actual interest rate. So as of today, Singapore interest rate for Singapore residential property, you are able to get interest rate between 1 to 1.1% pretty easily. If you're going for fixed rate, I believe that you're able to find interest rates at around the 1.2, 1.3% path rate. And of course, when talk about industrial property, I think the last I saw is around the 1.2, 1.3 mark as well. And that is pretty much the lowest that I've seen in the last 5 years, yeah, at least when I started property investment itself. Of course, once again, how long is this so-called low interest rate going to last? That's something that we all do not know. But if we take back into the past data when interest rate was this low, is actually this whole thing actually lasts around 7 years, 6 to 7 years. So if this scenario, if the pandemic is expected to continue, let's say for the next 1 to 2 years, or maybe even longer, then we then expect the interest rate to stay low for perhaps minimally 3 years or more. And therefore, then this again one strike as opportunity for many of us investors and even home buyers as well, which comes to this particular article that came out, which was that Singapore minister actually flags that risk of low interest rate. So they're basically saying that there's a risk of actually a low interest rate environment. And of course, most of us might ask this, is that, is there really a risk? Because low interest rate is technically good for the consumer, right? Because the intention for a low interest rate environment set by banks and all that is basically to encourage borrowing from the banks, which means that it also encourages spending by the consumer. And because it encourages spending by the consumer, then of course then it will help the economy to minimally sustain through this entire crisis in this scenario. So what is this so-called risk that the minister, because this Singapore minister is talking about? Because generally most of us will say, hey, it's a good thing what? Our home is cheaper, our mortgage is cheaper, everything we buy is technically cheaper. So it is good in a sense. So the main key risk that he's talking about is actually the indirect impact in this scenario where we focus on property, the indirect impact to a rise in property market. So why would there be an impact? Because once again, remember this, if there's a low interest rate environment, means that people are more likely to upgrade their home, or in this scenario, sellers also know that because of low interest rate environment, they are likely be able to find more suitable buyers to actually purchase their unit. And because of this actually indirectly will impact the property prices to actually increase. So I give you one very simple example, and you guys can actually do this exercise on your own as well. So if you actually take out any mortgage calculator, you can just Google mortgage calculator, or if you want to have a very simple calculator on your app, it's something that within our Quadrant app have it. So just go to App Store, Google Play Store, just go for Quadrant, and you actually have the app over here. So when we actually tap on the mortgage calculator and you play around the interest rate. So one thing that we can easily do is that we can type in $1 million over here, 1 million for property price, percentage down payment 20%, mortgage term 30 years, interest rate 2%. So why I put 2% is because prior to this entire pandemic, the interest rate was at 2%. So you'll see that actually the mortgage at a 2% interest rate environment versus a 1% interest rate environment. So everything stays the same except now interest rate from 2% become 1%. Is that you notice that the mortgage will be quite significantly lesser. To be exact, to put it this way, is that 2% versus a 1% interest rate environment with the exact same mortgage payment that you'll be paying to the bank, you can now actually afford a $1.15 million property instead of a $1 million property. Of course, take into consideration that you're enough for the down payment, yeah? So the end result of the mortgage would be the same, which means that technically now, if you are prepared to actually come out with a 2.5K mortgage per month to actually upkeep your property or upkeep your home, now technically, in a lower interest rate environment, you can actually afford something that is 15% higher price. Now, this would actually then mean that it could be to both ways, right? You as a buyer benefit to actually get this 15%, so-called, you're able to afford something that's 15% without technically paying extra in terms of the mortgage, or the sellers can take advantage of this low interest rate environment and price up their property by 15%, so that indirectly the buyers pay for it, but yet because it's a lower interest rate environment, technically the buyers did not really pay for it because it's almost the same, it's actually the same upkeep as per the $1 million property versus a $1.15 million property. So what does this mean for you as a homeowner and of course as an investor? Now, you must understand that the market is big. Therefore, not all sellers are that sharp to understand that this actually is happening, which means that there will always be a gap in the market over here. As a buyer, doesn't matter your homestay or investor, you should still take advantage of this low interest rate environment and get it at the price point that is pre-pandemic price point, at least pre-pandemic price point. So if this particular building was selling in 2020 at, let's say, for 2-bedder, 2-bath at, let's say, $1 million, we don't want to end up paying a $1.1 million in 2021 just because the mortgage is cheaper now. Yeah, so you want to ensure that you still pay, let's say, $1 million for that particular opportunity that is the same as 2020 coming into 2021, and then you will be then so-called the beneficiary of this low interest rate environment. So, and it is very, very easy for us as a buyer, especially when it comes to our own home, to easily want to overpay for a unit, because we always take a look at the end mortgage outcome and then we say that, hey, this is something that I can afford on a monthly basis. And because of that, we just become a little bit loose in our offering of price point. And that, of course, then you think about it, then of course, the sellers will benefit more than the buyers if you are the one buying. But then again, if you are on the other flip side, do understand that you as a seller now wants, of course, with this information over here, to take advantage of this low interest environment. You can use this as a selling point to the buyers, in the sense that, hey, you know what, your mortgage is actually way lower now, and therefore in that scenario, you know what, you can stay firm to a slightly higher price. So depending, of course, which side of the table you are, but nonetheless, you must understand the market have a lot of gaps due to the fact that majority of the home owners in Singapore will have very little experience in the buying and selling of property. And because they have very little experience in the buying and selling of property, you as a buyer or an investor you should actually capitalize on the inexperiencedness of the market, and then of course discover such opportunity for yourself. Okay, but of course, what that being said, let's go down to the conclusion of this is that interest rate impacts you as an investor generally positively rather than negatively. The only risk that I can really think of for you guys would be that remember, never ever overpay for a unit just because you see that you can afford it. That is the worst mindset to actually put that on. And of course, during my free free workshop, I actually share very in depth about the true meaning of lower interest rate. Is technically low interest rate is a natural hedge against the normal inflation, which means that it's actually technically the closest you can get to having free money. So I dive down a little bit into this during my free workshop. So if you have not attended any of my free workshop, I highly encourage you to just tune in to actually hear in terms of what I have to say and why I actually think that this time in the low interest rate environment is a very big opportunity for the resale market as well. But of course, in the new launch market, is there opportunity in the new launch market? Definitely, because if you were to buy a new launch 1 year ago as compared to today with the low interest rate environment now, you're also saving more money, but just be ensured that you choose the right new launch, okay, in that sense. So at the biggest risk for low interest rate environment will be that you over project in terms of what you can afford, because if interest rate were ever to just go back up 5 years later, 8 years later, then of course, then you might feel a little bit stretched when it comes to you maintaining the mortgage itself. But that being said, if you guys have been listening and tuning into most of our live webinar and our live Facebook Live and YouTube Live, you will know that property is something that is liquidable. So do not treat property like as though once you buy, you're stuck with it forever. So if you find that you have somehow overcommitted during a low interest rate environment and 5 years later, interest rate has gone up, do remember that by then you'll be out of stamp duty. There is no shame in actually going for a slightly smaller quantum unit. Just ensure that you're actually able to maintain your mortgage in times to come. Okay, so once again, to wrap it up, so in that sense, how should you actually navigate your property with prudence in the present market environment? I think number one, don't overpay for unit just because mortgage is cheaper. Number two, ensure that you are able to afford it as an investor. Make sure that your rent will be able to cover your mortgage as much as possible so that you will always be profitable. And once again, if you have weak holding power when it comes to you, let's say for example, having limited savings and everything, my encouragement to you guys is to still set aside 3 months what we call safety net or mortgage, so that if anything, if you have you have no tenants within a short period of time, then at least you have a float that you can actually maintain your property investment journey. So everything is all about setting safety net to actually ensure that you can pull this through very safely. So once again, low interest rate environment is actually good for home buyers and actually good for investors. However, once again, just be a little bit careful, because everything that's good is very common for us to overly take advantage of it and might get into an over leverage situation. Okay, so once again, it all dives down to really understanding what does leverage mean to you and really mastering leverage so that you will not be fearful even if interest rate goes up. Okay, and once again, I encourage you guys to just experiment with the mortgage calculator to really understand how does interest rate really impact you as a buyer. Play around with the fact that as of today, interest rate 1%, what happened? It goes up to 2%, what happened? It goes up 2.5%. One of the misconceptions in the market would be that your mortgage will double. So that is not true. Okay, usually your mortgage goes up to about 15%, 20%, with something that is usually, if you're in a mortgage of 3K range, your mortgage will probably go up to like 3.5K, which something is still very manageable for most of you guys. Okay, so play around the mortgage calculator, be very in tune in what does interest rate mean to you. Increase the interest rate, what does it mean to you? Look at your worst case scenario as an investor in a home sale, and you feel that, hey, even if interest rate goes up by 1% and you're able to afford that's $500, then you know that you're actually very prudent when it comes to investing. And once again, to wrap this whole thing up, is that invest safe. Always look at what's your worst case scenario if you're really afraid. And once again, do not be fearful of debt. Master debt so that you can be a better investor and a home investor, which is a hybrid between a homeowner and investor. With this, signing off, I'm Shawn. Once again, subscribe to our YouTube channel, subscribe to like our Facebook to be updated when we actually come live on live, and we are actually posting on new YouTube videos almost like 2 to 3 times a week. So I hope that you guys have been getting awesome value through that as well. Signing off. See you. Bye.